Welcome to the Investing Markets and Money podcast. And today we're talking about cryptocurrencies on quite a historic day here in the UK because the FCA, the UK regulator, has authorized access to listed crypto ETFs for retail investors, which is great news if you're a private investor who's been wondering about other routes into the crypto markets than just using a crypto wallet. And joining us on the podcast today, we have Dovile Silenskyte, who is joining us from WisdomTree, where she's part of the digital assets team, to talk about the implications of this decision and what it means for investors and for crypto markets generally. So welcome to the podcast, Dovile.
Thank you very much.
I wanted to really start with WisdomTree itself. So can you just give us a quick rundown on your firm's expertise in this area, what you're already doing in crypto markets?
Sure, I would be very happy to do this. So WisdomTree is a global, diversified business focused on issuing exchange-traded products across all asset classes. In crypto space here in Europe, we have a range of products across single coins and crypto baskets, and we have been managing products here in Europe for over 5 years now. So we have a long and successful track record with crypto ETPs.
So fair to say you've built up quite a lot of expertise through your existing European operations already.
Yes, very much so. A lot of expertise. And for example, my role is very much focused on researching digital assets, which is quite an important task to do because most people do not understand what value individual cryptocurrencies have or why should they invest into those cryptocurrencies within their portfolios.
And you've been dealing a lot with institutional clients, of course, who have been able to use these sorts of listed funds. But today is obviously a big move by the regulator to allow retail to access them as well.
Yes, today is an incredible day. So across Europe, and I have been traveling all across different countries, institutional investors and retail investors have been able to access these exposures via exchange-traded product wrapper for a number of years. UK has been on the sidelines and finally is catching up. So now we are talking to both institutional clients who are getting, for example, their platforms ready for retail to access these products. And also I will have, for example, a big webinar tomorrow where I'll be talking to retail investors and educating them why investing into Bitcoin, for example, the exchange-traded product wrapper is better than direct Bitcoin exposure.
Okay, better than going through a wallet.
Exactly. And I say this, and I'm sure that compliance colleagues may have some disclaimers around it, but for most individuals, managing separate wallets, remembering passcodes, making sure that they're not hacked, it's a very, very hard task. Just think about how many passcodes or passwords you have forgotten. I'm sure plenty. I always forget passwords and passcodes and everything else, or even forget that I have some investment on the side. So having an ability to obtain Bitcoin or Ethereum exposure within the broader asset portfolio that retail investors have will be a better way for them. And they will also outsource the management and custody and all the oversight functions to ETP issuer and their custodians.
And when we talk about crypto ETFs, which you'll see in the media at the moment, are they being structured like the ETFs that investors will be familiar with already, like an index tracking ETF, or do they have to be structured slightly differently and referred to slightly differently?
So when I talk about crypto in Europe, I always use the phrase ETP or exchange-traded product. ETP is an umbrella term that captures exchange-traded funds, exchange-traded commodities, and exchange-traded notes. The difference between the standard ETFs and ETPs is in Europe, we have UCITS rules, which have concentration limits. And for example, our Bitcoin exchange-traded product is 100% backed by Bitcoin. So it has 100% exposure to Bitcoin, so does not meet UCITS diversification requirements.
Right.
Yeah. But our products, for example, all of them are 100% physically backed, and assets, digital currencies, are held securely at a custodian in cold storage accounts with in segregated wallets. And those assets are not commingled across other funds or across other clients that custodian may have.
So what you're talking here, taking Bitcoin just as an example, it's pure Bitcoin exposure. You're buying what it says on the tin, basically.
Exactly. When you buy Bitcoin exchange-traded product, all that you get is Bitcoin exposure.
And when we're looking at the wider ETF sector. Is that what a lot of other managers are doing? Is it pure exposure, or are they using other means of getting that that economic participation, that crypto price?
So in Europe, we still have synthetic products that obtain, for example, Bitcoin exposure via Bitcoin futures. But I always tell investors to choose physical or synthetic because of future roll costs. Because Bitcoin futures have quite large contango, and that results in additional costs that investors avoid by having investment in physical product.
So that can basically erode your upside performance because the underlying futures contracts are still being recycled by the manager.
Correct.
Understood. Now, we did actually touch on custody. Obviously, a lot of retail investors in the UK have been accessing crypto through wallets. Can you say a little bit more about the custody arrangements? I know you've touched on it already, but the level of extra safety that brings.
Yeah, so let me talk about the whole operational model of exchange-traded products here in Europe. And I always tell everybody, I'm a proud European, and you will see why this phrase makes sense here. Because we have had this model in Europe from day one. And day one was back in 2019 when we launched our Bitcoin product. In the US, the model was slightly different until August this year, but now Securities and Exchange Commission are moving closer to what we have here in Europe. So the way it works is, you as an investor, you only trade on secondary market. So you go to your broker or you go to exchange, and for example, you have £100 that you want to invest into Bitcoin exchange traded product. You give your £100, that £100 goes to authorized participant who goes to crypto market and exchanges that £100, of course minus their offer spread, for Bitcoin. And then they deliver Bitcoin in kind to cold storage account at a custodian. Cold storage accounts, when I talk about them, and most people say, what are they, how do they work? I always say, imagine USB stick that you put in a drawer. That is, it's not connected to anything, so it's harder to hack it. I'm sure that smart individuals could still find a way to hack it. So because of this reason, custodians have insurance that is there to protect the fund in case somehow Bitcoin was taken out of the cold storage account. But cold storage accounts are there purely for the benefit of the fund investors. So if you have £100 and you invest that into Bitcoin ETP, that £100 minus offer spread buys Bitcoin. That Bitcoin is moved into the cold storage account. So every single day you can go onto WisdomTree website and see what coin entitlement your £100 investment gives you. And assuming that Bitcoin ETP trades at, let's say, £25 per share, and here I'm just making up a number, your £100 investment would give you 4 shares. So every single day you could check how much Bitcoin there is within every single share. And of course, there will be tiny fraction of Bitcoin just because its price is over 120,000 US dollars. Yeah. So, once you do the math, you see that you'll have very small allocation, but you're able to view that allocation, and it should only change by management expense ratio. So over time, that allocation will gradually reduce because management expense ratio will be taken out of it. And for products that do staking, such as Ethereum, staking returns tend to be higher than management expense ratio. So in those cases, you could see your coin entitlement growing over time.
So with Ethereum, you've got that extra yield benefit, effectively.
Yes. So I like talking about it as something that you get for participating in the governance of the Ethereum blockchain. So when ETH that you're invested in is staked, it stays within the cold storage account at a custodian. It does not move. It's not in any way similar to lending when you have counterparty exposure or when you move it out and hope to get it back someday. It stays within your cold wallet, but staking introduces 2 risks that I tend to highlight. Risk number 1 is slashing. So in case validator who is using the ETH that you have staked validates invalid transactions, then you could lose part of ETH that was staked. So for this, our custodian has insurance. So you as innocent bystander would not cover the bad actions of the validator. Insurance would cover that. And the other risk, which is much more significant, is liquidity risk. It takes time to unstake ETH. In normal market conditions, I say it tends to take 10 to 11 days. In current market conditions, it's taking over 40 days.
Wow.
Yes, and our product has daily liquidity with T+2 settlement for redemptions. So for us to be able to ensure daily liquidity, we only are able to stake a small portion of the product.
Right. So you're effectively, your product has got superior liquidity to actual physical Ethereum.
Correct. So it has slightly lower staking return because if you have direct ETH investment and you staked everything and suddenly you want cash, it will take you now a month and a half to get that cash. In our product, you invest cash. At the moment, we target staking 40% plus minus 5% of fund's net asset value. So staking return that you get in our product is less than half of what you get by going directly in ETH, but you have daily liquidity. So if you need cash, you can get it on T+2 basis.
So this is basically really good news now for retail investors in that those who felt, oh, crypto's risky, or, oh, I don't really understand wallets, or, you know, I'm worried I'll get hacked or defrauded. Now you can actually just invest in crypto through the same avenues that you might be buying stock or other ETFs.
Exactly. And I have been talking to a large number of platforms here in UK who are getting ready to offer these products alongside the current products, equities, fixed income, commodity ETFs. So for investor who wants to have crypto exposure within their portfolios and who sees value of having small allocation to crypto, now they have a seamless way to do that.
And we've touched on this already, but in terms of the liquidity and the secondary market risks, you're basically ironing all that out so people don't have to worry about that.
Yeah, so for a retail investor, they do not have to worry about any of the liquidity risks because these products are as liquid as the cryptocurrencies themselves. And Bitcoin has extraordinary liquidity. Billions of it are traded a day. Ethereum also has very, very high liquidity. And for investor who wants to buy or sell, I'm sure they'll be able to have their trades executed easily on secondary market.
That's great. And will these products be eligible for inclusion in ISAs or SIPs, or is that too far down the road at the moment?
I do hope so, because I, as UK taxpayer who has ISA, I want to be able to invest into Bitcoin out of my ISA because that's a very good long-term investment vehicle. But as far as I know, we are expecting HMRC's feedback, which should be potentially coming today.
Today?
Potentially.
Right, okay.
So this is what I heard yesterday. I do not know if I can trust that or not, but HMRC is intending to comment on this. Looking from outside, and I know what answer I want to hear from them, but there is no reason not to allow crypto ETPs within ISAs. These products are no different than gold exchange-traded products. So if gold is allowed somewhere, Bitcoin should be allowed in the same place.
Yeah. And in terms of the markets that are being made available at this stage, is it just the mainstream ones like Bitcoin and Ethereum, or will others potentially come online as well?
On day one, it will be only the products that are currently listed on London Stock Exchange. Last year, when FCA allowed listing of products on London Stock Exchange, they limited to Bitcoin and Ethereum. And at that time, they limited trading just to professional investors. So now what's being done is those are the same products, but in addition to professional investors, retail will be able to trade them as well. I do hope that in the near future, and I call that near future day 2, that other exposures will be made available. Because in my eyes, for most investors, Bitcoin is the entry point in digital assets. And once an investor has Bitcoin for a while, he or she starts looking outside, what else could I have alongside Bitcoin? Investors do not want to concentrate their digital asset exposure into a single token in the same manner as they do not want to concentrate their equity exposure to a single stock, let's say Apple, or their fixed income exposure to a single, let's say, high yield bond. Yeah. People want diversity. So for most investors who want to go outside their initial Bitcoin investment, broad crypto basket is the way forward. And we as WisdomTree, at the moment we have 4 crypto basket, exchange traded products that are also 100% physically backed, but that provide broad exposure that most investors would benefit from in addition to their Bitcoin investment.
But just for clarification, those basket products are not going to be available for retail investors at the moment.
Not at the moment, no. So these products are available on European exchanges such as SIX, etc., Euronext. And people who are able to trade there, they are able to buy those products. But in London, we will need to work with London Stock Exchange to get them listed and made available for retail.
Oh, okay.
Yeah.
Understood. And what about, looking further down the line, do you foresee a situation where leveraged products might become available? The sort of, what I'm thinking of here is that sort of ×2 or ×3 leveraged crypto. I know quite some time ago, the UK regulator banned the offering of spread bets and CFDs based on crypto prices, but that leverage was a lot higher. It was at least 10 times on the underlying currencies. Do you think there might be scope further down the line for those sorts of products? For the active, I'm thinking more of the active crypto trader here.
I hope that baskets will be made before leverage products are made available. Because leverage products, they are quite niche and they are not suitable for broad audience, especially broad retail audience. I am always telling every single investor I talk to, please do not ever panic buy or panic sell cryptocurrencies. Please always have a clear mind. And when I say clear mind, that is run homework, see what crypto allocation suits your overall portfolio, know what plans you have. Is it your long-term investment? Are you saving for the next 5, 10, 15 years? Or do you need cash sometime soon? Because that should drive your allocation decisions. And then decide on rebalancing frequency and rebalancing triggers. And leverage products do not really fit this criteria because they are more tactical plays, more when somebody wants to buy or sell when they see some news or hope to see some news. And they may want to trade in and out within a day. So that's great for people who want to actively trade, but majority of retail should not do that. Majority of retail do not have the necessary expertise for those trades to be successful. And all that I want to achieve in my role is to educate people about the value of having some crypto within their portfolios, but I do not want them to be hurt by having that crypto exposure. So they have to be sensible, be smart, and start going with standard unleveraged exposures. And once those exposures are no longer sufficient, hopefully they'll be able to go with broader exposure instead of leveraged exposure.
Yeah, I've seen some wealth managers here in the UK suggesting somewhere between 2 to 5% overall exposure to digital assets. So that's a broad range of stuff, not just Bitcoin.
Yeah, so what I tend to say is for most investors, being market cap neutral should be their target. And when I take a look at market caps of all listed tradable instruments, as of end of September, digital assets represented 1.6% of the total market cap portfolio.
All right.
And of course, this 1.6%, it varies. Like at the end of August, it was 1.7. At the end of October, it may be something different than 1.6. So approximately 2% allocation to crypto is a market cap neutral allocation. And that should be the starting point. And I like saying that if you have 0 in your portfolio, then you are actively underweighting this asset class.
Yeah.
And of
Good
course,
point.
you may want to actively underweight because it does not suit your investment goals, criteria, beliefs, but please run the homework before making an active decision. And of course, if somebody invests 5%, they are actively overweighting. So once again, please run the proper analysis to make sure that it is appropriate for your portfolio.
And just finally, I wanted to ask you more from a sort of high-level ETF industry perspective. Do you foresee a situation further down the line where you might see actively managed crypto products coming on the market? I know your basket product follows more of a passive systematized approach, but something where that allocation would be more actively managed within an ETF.
So there are already a number of actively managed products, and I review all the products available globally and try to classify them, whether they are indexed or whether they are actively managed. And there are a number of actively managed globally, not in UK. But I always tell everybody, please make sure that whatever is done actively actually delivers value for you. Because an investor may end up going into a very expensive product that achieves a return that is very similar to Bitcoin return. Then why take the risk? Why pay extra money when you can have a single asset exposure to Bitcoin and still benefit from digital asset performance?
And it's always important for investors to, and a lot of them don't do this, but pay attention to the total expense ratio, which is a measure of the overall cost of holding that ETF. So the higher that number, the higher an annual fee you're going to be paying. And a lot of these active ETFs will be charging potentially quite hefty fees.
Yes, and actually, this is a very good topic, and I'm glad that you raised it. Expense ratio is very, very important to look at. And for products at stake, it is very important for investors to do simple math, which is staking return that the product is promising or estimating minus the management expense ratio, and taking a look at the net figure that you will end up getting. The higher that figure, the better, because it means that you are outperforming the standard non-staking exposure. But it's very, very important to do the math, because there are some products that have high staking return and very high management expense ratios. And there are products that have no management expense ratio and low staking returns. So subtracting 0 from a low figure or subtracting high number from a high figure may end up giving you relatively insufficient outcome.
So there's a big risk here that you're comparing apples with pears.
Exactly.
Without realizing it.
Exactly.
Yeah.
So it's very important to do this basic math. Staking return that you expect minus management expense ratio. And then if you ever see very high staking return, ask ETP issuer, how is it achieved? For example, for our Ethereum product, we limit the amount staked to manage liquidity risk. Others may have different approaches, or they may deal with liquidity risk differently. So you as an investor, you need to make sure you ask these questions and understand the responses that you're given.
Understood. And just to finish off, if someone's interested in finding out more about your commentary and the analysis that you've mentioned already, where can they go to sign up for that?
Oh, they can go on our website. Everything is published. Everything is free to read, free to review. And if there are ever topics that you would like me to write about or comment on, please send us a quick email. Very happy to take feedback from both retail and institutional investors about what is of interest to them and target the materials that are produced to those interests.
Fantastic. Well, thank you, Dovile, for joining us today. It's been really, really informative.
Thank you very much.
Thanks a lot.
Thank you.